All right. Today is Thursday, December 1st, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight, but before we start, 3 notes. Note number 1. Yesterday, we talked about Elon Musk declaring war against Apple, and the same day, Elon Musk came out and said, hey, Tim Cook gave me a tour in Apple HQ, and we resolved the problems. They gave us assurances, yada, yada, yada. And a lot of you say, hey, Maverick, what are you talking about? Elon Musk declaring war against Apple? You're just exaggerating things. Everything is hunky-dory. Really? For one thing, you don't understand power moves. What Elon Musk did is he barked too loud, and of course Tim Apple panicked and he invited Elon Musk into the campus. Hey, look, we're not gonna censor you. We're not gonna do anything here. Please don't bark at us. Our stock is already going down. Let's take it easy, okay? But here's the thing. Elon is just securing these assurances, and he's humiliating Tim Cook publicly. But if you think that Apple is not going to censor Twitter, you better wake up. For one thing, Twitter now ended its misinformation policy. You think this is going to jive well with Apple? Number 2, Elon Musk is now shifting Twitter from the dependency on advertising, which is a dying model, by the way. As a YouTuber, I know that the ad revenue is depleting. It's not here. It's dying. And the only ways you have to depend on your own users, in this case Twitter, is charging users $8 a month to get the verified thing, and this will be their main source of revenue. Well, guess what? If you're paying Twitter the $8 a month using your iPhone, the iMob Apple is going to get the 30% cut, aka the rent.
For the rent. The rent.
You think Elon is going to be okay with that? This battle is not over, not even close. And even Mark Zuckerberg bashed Apple and came out and said that it is problematic for one company to control what kind of app experiences get onto a device. So now we have the oligarchs versus the other oligarchs. And I say if two assholes want to go at it, pass the popcorn. Note number 2. A lot of you asked me what is the movie scene from Monday that I used in the outro. This is a scene from the movie Thief, 1981, starring the late James Caan. And it is the diner scene. So the movie Thief is, to begin with, absolutely fantastic. But this scene, they actually teach it in college, even today, because it is a cinematic masterpiece. This movie was the first movie for Michael Mann, a phenomenal producer and movie maker, but the late James Caan said that this was his favorite movie scene that he did ever. Out of all of his movies, this is the scene that he enjoyed the most. So if you have some time, go watch this movie, Thief, 1981. Now, note number 3, I noticed that my recording is cutting off at some point or is glitching. What I see here as I'm recording, sometimes it freezes, as if the recording is hitting a bump and then it restores flow again as nothing happened. But what you guys hear is a bump, a glitch, as if the signal is cutting, and I'm not really sure why. Is it because of the sound card in my computer? Is it because a memory issue? Why does the recording freeze momentarily and then it restarts again like nothing happened? Something is going on here, but I'm not an audio expert, so I know some of you are, and if you know why this is happening, just let us know in the comments. And thank you so much in advance. And with that out of the way, let's move on to the main course of tonight's program. And here it is, in focus tonight. Meh. That's what the market says about the J. Powell rally. Now, you might have noticed that yesterday, the Dow Jones, the Nasdaq, the Russell, the S&P blasted higher after Jerome Powell pretty much said nothing. Same old, but the market got a sense of relief that Jerome Powell did not come out hawkish and killed the rally that was already in the making. But you would think now maybe we have more clarity, at least according to the bulls, they have more clarity that the Fed is going to step out of the way and they're going to stop interest rate hikes by January. It's over. So why wouldn't they buy the stock market? Why wouldn't they go all in at this point? Because this is the bottom, right? Well, they're not doing so. Nobody's doing so. If anything, market participants actually faded the rip and used the J. Powell bump to dump about $11 billion worth of stocks. A mass exodus from the SPY and the Qs, the likes that we have never seen since at least 2020. Now, all of this dumping and exodus, the cash will go somewhere. Is it going to stay in cash? Is it going to chase the TLT in bonds, for example? Is it going to go chase the dip in oil? Who knows? But what we know for now is investors are not excited about the rally that we got yesterday. They're not buying the J. Powell bump. And even the criminals of BlackRock, they're not chasing the Powell rally. Nobody wants to buy the Powell rally. What's going on here? What's wrong with you folks? You've been saying, hey, Fed, you're over-tightening. You got to go from 75 to 50. That's all what we want. We want 50. Okay, Jerome Powell came out yesterday and said, we'll do the 50. And you guys are not buying still? What's wrong with you? Maybe because you're afraid of the recession, right? Maybe inflation is going down for the wrong reasons. Isn't it? So here's what I like to do. We get a lot of macro data pretty much every single week, but I'd like to divide them into expansionary, inflationary, and recessionary because we have conflicting data every single week. A lot of folks say, hey, this piece of data indicates that the economy is heading into a recession. And then comes another piece of data that says, hey, maybe the economy is going to hit a soft landing. Another piece of data indicates that inflation is not abating. What do we do with all of this? And I thought maybe we should segment each macro data that we get between expansionary, inflationary, recessionary, and then perhaps by the end of the month, we see which is the predominant theme. You like this idea? Because I do. You know why? Because not so long ago, we talked about the different themes in the stock market, expansion, inflation, recession, which sectors of the stock market lead under each theme. We see the market right now in confusion. One day showing an inflation theme, the next day it's showing a recession theme, then an expansion theme. So what's going on here? I think the macro data, if we track it every week and every month and we segment it into expansionary, inflationary, or recessionary, we see which one is the predominant theme, it would help us invest the right way. So let's go over the data that we got this week. We got the JOLTS, job openings and quits, and the number fell to 10.3 million open jobs for now. And the ratio of openings to the unemployed workers is 1.7, meaning for each unemployed individual, we have 1.7 jobs available to that particular individual. Now again, is this recessionary? Of course not. We have plenty of jobs open right now. And by the way, I told you that this number is a fugazi. I don't believe in it, but we'll take it at face value. The JOLTS number, despite the drop that we got recently, remains in expansion territory. So we're going to place this in expansionary. JOLTS. There you go. And this week, we also got the ADP employment report, and it shows that the economy created 127,000 jobs in November. Again, we'll take the number at face value. I don't believe that the economy really created over 100,000 jobs, but to each his own. We have to look at the data because we're getting more and more news of companies laying off employees. The recent one, DoorDash, laying off about 1,250 employees, and that is just the beginning. But somehow the ADP report shows that the economy created 127,000 jobs in November 2022. 127,000 exactly, not 127,001. Just saying. But anyways, according to the ADP report, because the devil is always in the details. The number on face value looks good, right? The economy created over 100,000 jobs in November. But when we look at small businesses, 1 to 19 employees, they created about 5,000 jobs in November. Small businesses with 20 to 49 employees lost 56,000 employees in November. When it comes to mid-sized businesses, those employing 50 to 249 employees created a stunning 283,000 jobs in November. Are these all hedge funds? I don't know. But anyhow, mid-sized businesses with 250 to 499 employees lost 37,000 jobs in November. Now, large businesses with over 500 employees lost 68,000 employees. When we look at the goods sector of the economy, natural resources and mining created 16,000 jobs in November. Construction lost 2,000 jobs. Manufacturing lost a stunning 100,000 jobs. When it comes to services, trade, transportation, and utilities added 62,000 jobs in November. Information down 25,000 jobs. Financial services down 34,000 jobs. Professional and business services down a stunning 77,000 jobs. Education, health, and services created 55,000 jobs in November, and here it is. Leisure and hospitality created 224,000 jobs in November. When it comes to other services, they added 8,000 jobs in November. So again, the majority of the jobs created, if you believe the ADP report, came from the leisure and hospitality sectors of the economy, which is the most cyclical, the most sensitive sector of the economy to what? To the economic cycle. We know there is, you want to talk about a lag? There is a lag in consumer spending. There is a lot of demand for leisure and hospitality right now until, of course, the consumer runs out of spending reserves. We talked about consumer savings down the toilet, and they're now swiping those credit cards up and down, up and down, up and down to continue to spend. And for now, The leisure and hospitality sector remains really hot. I was just in Vegas. I know what's going on. The town is busy, the tables are full, business is hot. But as we see the recession force creeping into the economy, courtesy of the Fed's interest rate hikes, we're going to lose these jobs so fast your head is going to spin. But in the meantime, when you have an ADP report that shows the economy created over 100,000 jobs in November, is this recessionary? On face value, the answer is no. But if you dig into the details, yes, we have some recessionary forces showing up, with, for example, manufacturing losing over 100,000 jobs. But the headline number is positive, and therefore we're going to add the ADP report under the expansionary theme. Next, we have the Chicago PMI, and Lizanne Saunders says, yikes. November Chicago PMI fell to 37.2 versus 47. That was the estimate. A massive drop in the Chicago PMI. And now the reading is actually flirting with the lows from 2020 during the Thing crash. But listen to this. Prices paid rose at a slower pace. Once again, rose. And that's not a tulip either. That means it went higher. On the other hand, new orders and production fell at a faster pace. Inventories rose at a faster pace, and employment fell at a slower pace. Now, a lot of folks on Twitter and the likes, the experts, they've been yelling and screaming at the Fed, look at what's going on at the Chicago PMI. The economy is crashing. This is a recession. Stop now. Yeah, the headline reading is crashing into a recession territory. That's for sure. But look at this. Any reading above 50, that means expansion. Any reading below 50, it means contraction. We will look at the business barometer, for example. That is the headline reading, 37.2. That's recessionary. That's contraction. But look at prices paid. 66.2. This is still in expansion territory. In other words, to get prices paid down to 50, where it should, or perhaps below that, you need to crash the business barometer, aka the headline reading, all the way down, perhaps to the 20s. What am I saying here? For the Fed to get prices down to defeat inflation, they need to create a recession, perhaps even more severe than 2020. The reading in the business barometer of the Chicago PMI perhaps needs to go down to the 20s before you see prices paid going down closer to 50. So when folks say, oh, the Fed is doing enough, it's going to over-tighten, yada, 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 you have no clue what you're talking about. To defeat inflation at this point, you gotta create a recession. That is economics 101, baby. So we're going to add the Chicago PMI in the recessionary category. There you go. Next, we got some data from Nevada, and the gaming revenue continues to go higher and higher and higher. The gaming revenue is in a winning streak right now and exceeded $1 billion for the 20th straight month. People are gambling. People are betting like crazy. They're gambling in the casinos. They're betting on football. We're talking about billions of dollars. So again, is this piece of data recessionary? The answer is no. It is inflationary. So we're going to add this under the inflationary category. Next, today we got the update from the Atlanta Fed, the GDP reading for Q4, and they got it down. They downgraded the GDP estimate big time, down from 4% all the way under 3%. And let me fix this one for you, and here it is. Yep, much better. But all joking aside, assume that the Atlanta Fed is right and the GDP will be above 2% in Q4. Again, is this recessionary? Is this inflationary? The answer is no. The answer is this is expansionary. So we're going to add the GDP from the Atlanta Fed under the expansionary theme. Next, today we got construction spending, and it went down in October. Matter of fact, construction spending down by 0.3% month over month versus the estimate of down 0.2%. So again, this is a negative reading. This is in contraction territory, meaning it is recessionary. So we're going to add consumer spending under the recessionary category. Next, today we got the manufacturing PMI, and the headline reads, November sees the first deterioration in U.S. manufacturing performance since June 2020. So this is going down into contraction readings below 50 for the first time since 2020. Is this recessionary or not? The answer is it is. So we're adding this under the recessionary category. And by the way, contrast the U.S. manufacturing PMI, which is in contraction territory, to the Russian factory activity PMI, which is growing at the fastest pace in almost 6 years. How is sticking it to Putin going on? Because it seems that we're sticking it up our own ass. Russian factory activities expanding at the fastest pace in almost 6 years. On the other hand, U.S. factory activities slowing down to the lowest level since 2020. I think by now you should know that this whole thing is a scam. This whole thing is backfiring and it's not working out. It is hurting our own economy, but not hurting the Russian economy at all. Anyhow, Now, according to the data that we got so far, we have 3 pieces of data under the expansionary category, we have 1 under the inflationary category, and then we have 3 under the recessionary category. And if we continue to track this week after week, by the end of the month, we'll get a clear picture whether the economy is indeed heading into a recession or more inflation, or perhaps a soft landing, the fantasy of a soft landing, if we see more and more expansionary data. Now, the last piece of data that we got today is the PCE inflation report. And the headline reading is, PCE inflation up 0.2%, less than expected, right? Good news. Good news. Inflation is going down, right? How about wrong? Because, listen to this, while the core personal consumption expenditure price index rose 0.2% in October, slightly below the estimate, the index is up 5% year on year. So far, so good. But here it is. The personal income jumped 0.7% for the month, well ahead the 0.4 estimate. In other words, wage inflation went higher. And if you think this is peak inflation, you better wake up now. So we're going to add this into the inflation category. We are going to continue to add more and more data on this board and see where it leads us. And here's the last thought. When we talk about themes and which stocks you're going to buy right now, because a lot of you say, hey, Maverick, you're a perma bear. You're all about the FUD. You're the doom and gloom. Meanwhile, I actually bought some stocks recently, and I have a checklist for you. When I buy any stock right now, I'm looking at number 1. When we look at the reports, the last report for the company, any company you want to look at, does the report show that this company has the pricing power? How do you know that? Is the company increasing prices but not seeing a drop in the volume of sales? We covered those earnings in details. And then, is the rate of growth in revenues year over year, quarter over quarter, doesn't matter which ratio you want to look at, is this growth rate exceed or not exceed the growth rate in expenses and cost of goods sold? If it does, so far so good. It means this company has the pricing power. And number 2 on my checklist is the product or the service provided by this company a necessity or not? If it's not a necessity, for example, an iPhone, a software that you don't have to use really, then it doesn't fit the category. But if it is a company that produces food, for example, or medicine, or a utility, that's a necessity. You can't really let go of that. As a consumer, you have to continue to pay for food, for utilities, for medicine, and many other categories. Number 3 in the checklist is, now that the dollar is down, go back to the earnings that we've done throughout the earnings season in this program right here. What companies were doing pretty good? They have the pricing power. The consumer continues to spend. But the only headwind that they got is a higher dollar. Because now that the dollar is going down, this will be an added tailwind for the earnings of this company, whatever company it is, in the next quarter. So these are the kind of companies I'm adding in my portfolio right now. Here's the other thing. I'm not buying because I think it is a long-term buying opportunity right here. I'm only renting these stocks because, unfortunately, even if these stocks are good and their valuations are not inflated, we have the ETFization of the stock market. And unfortunately, when the big guys go down, they take everything down with them. So if we have a crash coming in the stock market, even the good stocks are going to go down. But in the meantime, if you must chase anything at all, then rent these names that fit this category. The stocks that meet this checklist. They have the pricing power, their product or service is a necessity, and the company benefits from a falling dollar. Anyhow, folks, we're going to talk about this a lot more in upcoming videos. But for now, I'm just floating the idea, and we're going to add to it in the days to come. But for now, I'm going to cover the stock market information for you. We begin with the closing of the indices today. And here we go. The Dow Industrial Average down by 194.76 points, or a decline of 0.56%. The Nasdaq flattish with gains of 14.45 points, or a gain of 0.13%. The S&P in the red down by 3.54 points, or a decline of 0.09%. Now, the Dow was the underperformer because Salesforce went down big, I believe by almost 10% for the day, and that impacted the Dow negatively. When it comes to the sector's performances today, all over the place, but at number 1, capturing the gold medal, healthcare, but at number 2 for the silver. Materials, number 3 for the bronze, technology. The laggards for the day led by energy, financials, and utilities. No theme at all here, but notice the consistent outperformance by healthcare. Now, what about the advance to decline ratios? NYSE 48% advancing versus 50% declining. The Nasdaq 50% advancing versus 47% declining. On to commodities. Energy commodities were down for the most part, with exception of the WTI, which advanced by about 1% for the day. On the other hand, Brent was flattish. Gasoline RBOB down almost 1.5%. Heating oil down about 3% or so. Natural gas down about 1.5%. Now, we have some good news, or maybe bad news, depends on how you look at it, for energy commodities. For one thing, all of this tough talk by the Europeans re the Russian price cap, well, after all of this barking, they're going to approve a $60 a barrel price cap, which is, by the way, the same price the Russians are selling oil to the Indians at. So much for the price cap and all of these threats, if this is indeed the price they're going to settle at. But the market was expecting $40, $50. So to have $60, that's a good floor, isn't it? That means that at least energy commodities will keep the levels of 80 when we talk about the Brent at least. On top of that, when we look at Saudi crude shipments to the US, that went down to the lowest level since 2017. What does that mean? Saudi is cutting the production here. Now, the analysts say that this is a follow-up of the previous output cut by OPEC+. I disagree. I don't think this is just coming from the previous output cut. The Saudis are cutting right now, indicating that there is another large output cut coming from OPEC+ in the next meeting. That is yet another added tailwind for energy prices to continue to move higher. Back to the futures, when we talk about softs, lumber down almost 4% for the day, coffee, the crash continues, down yet another 3% or so for the day, OJ down by about 1.5%, on the other hand, sugar flattish for the day, yet we have some gains, led by cocoa, a little over 1.25%, and then cotton futures with gains of a little over 0.5 percentage point. Now, the dollar was down today, and it broke an important technical formation of a double bottom. Immediately, metals blasted higher. Massive gains for gold, silver, platinum, copper, palladium. Look at silver, with gains of almost 5.5% for the day. When it comes to meats, flattish activities for live and feeder cattle futures. On the other hand, the new big tech, lean hogs, scoring gains of almost 4.5% for the day. When it comes to grains, down across the board, and the declines were led by soybean oil futures, which lost about 6.25% in today's session alone. And the reason is because we have news from Argentina. There is something called the soy dollar that they're floating, and this has added more pressure on soybean oil prices. On to the big casino, the options market. What's going on here? The volume went down a little bit for the big guys, but it moved higher in other names. We're going to cover all of that. But the good news is we're seeing more buying of calls than puts, at least for now. And the hottest table by far remains Tesla, with around 1.8 million contracts traded today. About 62% of those were calls. This is, of course, in anticipation of the revelation of the semi-truck, which we've been waiting for since, 2019? If that is a bust, the stock goes down. But folks are anticipating a pop based on semi-truck optimism. To each his own. Apple at number 2 with around 1 million contracts traded today. About 50% of those were calls. Look at this. AMC, baby. Apes up big today. And guess who predicted all of this? The answer is the guy you're listening to right now. We're going to cover the charts of AMC and many other charts that I talked about tomorrow. In the meantime, AMC came up number 3 with around 950,000 contracts traded today. About 66% of those were calls. On to the unusual activities that took place in the options market today, and we start with the ticker ARKKKKK for Tesla witch Cathie Wood. And by the way, at what point do we realize that Cathie Wood will end the same way of Sam Bankrupt Fried? RKK is the next FTX. You watch. And somebody sees more declines coming here for RKKK, and they bought the 34 puts for the expiration date, January 20, with expectations that the name could move down and lose more than 10% of its value by then. They paid around $1.40 a piece to enter this trade, all in all spending around $1.5 million. And then what about FCX, Freeport McMoran? If you believe that the dollar is going further down, then you should be long copper. And the easiest way you can do that is go long FCX, buy some calls. Here's somebody doing exactly that by buying the 48 calls for the expiration date February 17th, with expectations that FCX could add more gains worth at least 21% or more by then. They paid around $1.20 a piece to enter this trade, all in all spending around $1 million. And then what about the ticker DOCU, DocuSign, a name that I've been shorting since 2020 and I haven't covered yet. But perhaps maybe it's a good idea to cover now because somebody sees the stock moving higher. And they bought the 51 calls for the expiration date, December 16, with expectations that DocuSign could move higher and score gains gains, worth more than 5.5% by then. They paid around $3.60 a piece to enter this trade, all in all spending around $2 million. And then what about the ticker TSLA, the souffle Tesla? Somebody bought the 205 calls for the expiration date, January 6, with expectations that the name could add gains worth more than 5% by then. They paid around $10 a piece to enter this trade, all in all spending around $5 million. And then what about the ticker XOP? This is the oil and gas ETF, and they continue to short here, and therefore I continue to buy puts just in case. And this could be a hedge, by the way. This could be somebody who owns the XOP, but they're hedging. Either way, they bought the 134 puts for the expiration date, December 16, with expectations that the name could move down and lose more than 10% of its value by then. They paid around $1 a piece to enter this trade, all in all spending around $600,000. On to the heat map. What's going on here? All over the place, but let's try to spot a theme. For one thing, energy is down. That's recessionary. And then we have some software and tech moving higher, but not the big caps. That could be short covering. It could be options activities. We're not going to read a lot into that. But then when we look at healthcare, for example, look at Pfizer, up almost 2%, outperforming the market. Is this recessionary or not? It's exactly the kind of stock you want to be in a recession. Then you got consumer defensives. The stores, Costco, Dollar General, which we're going to talk about in a minute, all down big for the day. That's recessionary. These stores used to benefit from inflation. Now they're going down because the recession is already here for the low-income consumer. But look at a name such as PM, tobacco, Philip Morris. That's blasting higher. And again, this is under the recession theme. So the predominant theme remains the recessionary theme. Of course, gold is blasting higher. Gold miners are moving higher. That is because the dollar is down. But when you look at the theme all in all, the recessionary theme continues to outperform. Now let's talk about some corporate news here, starting with the souffle Tesla, which is recalling 435,000 cars in China over a rear light issue. The recalls continue. And since we're talking about auto manufacturers in China, the thing lockdowns over there are slowing down production for VW, Toyota, Honda, so the supply of new cars will take a little longer to arrive into the market. Again, this is inflationary because we have lack of supply, which will increase the prices of the inventories that these companies have right now. And here it is, Dollar General. What's going on here? Cash-strapped Americans are increasingly turning into discount stores for essentials. However, supply chain constraints are keeping Dollar General from taking advantage. They cannot get the goods to begin with. This is the problem. Why, you might ask? How about the lockdowns and shutdowns in China? All of these goods you see in these stores coming out of China. Well, nothing is coming in right now, and folks say, but shipping rates are down, Maverick. Inflation is gone. Yeah, they're down for the wrong reason, genius, because nothing is coming in. The factories are shut down. Of course, shipping rates are going to go down. And then we have some good news from a company that I'm shorting, Blackstone, and I sense some panic here. Blackstone was down big today, and the reason is they're limiting withdrawals from the $69 billion real estate fund. Now, I used to work in Vegas in the casino industry, and I know that Blackstone took a lot of risk, and after the pandemic, they took even more risk in buying these properties, overpaying. They didn't care. But now reality is coming back to bite them right in the ass. And this is why I'm shorting the stock. Now, I've been shorting the stock since the beginning of the year, and it continues to go down. So far, so good. And I say burn it down, damn it. And hopefully BlackRock is next. But anyways, we talk about which stocks you should be in, continue to hold. How about the defense contractors with all of this money laundering in the Ukraine mission? Now we have Raytheon winning a contract worth about $1.2 billion to send surface-to-air missiles to Ukraine, not the United States Army. Ukraine. But who cares? If you own the stock, more money coming your way. Onto the heat map for the ETFs. Again, muted across the board. We're not seeing a contrast between growth or value. We're not seeing a lot of outperformers or underperformers. It is mostly flattish across the board. But notice this. Number one, the TLT is up big today. That is recessionary. Number two, you got the GDX, gold miners, silver, the old school, precious metals, safety. When we talk about the TLT, bonds equals safety, gold equals safety, silver equals safety, the ultra defensives. When the economy is heading into a recession, when the stock market is not working anymore, you go long bonds, gold, silver, tobacco, food, and this is what we're seeing right now. So even amidst days where the stock market is going higher, we continue to see the recession theme outperforming, and this should be alarming to everybody. On to charts, and we begin with SPY, the S&P 500 30 minutes chart. What do we see here? We got a gap higher in the morning, but the chart could not make it above 410. Then it reversed all the way down, and it revisited the support at 405. The support at 405 was so far so good, and the chart moved higher all the way till the end of the day, closing pretty much at the mid-range between 405 and 410. But all in all, the formation is of a bear flag pattern. You combine that with the RSI being elevated along with the MACD, the risk versus reward says the bear flag plays out and we see a retest of 405. Here is the daily chart for the continuous contract for the S&P 500. Again, did we see a lot of damage today? The answer is not at all. The chart remains trading above the important support of 3,960. It attempted today to crack above 4,000. In this case, 4,100, and it couldn't make it. But we're not seeing any reversal signal here. We're not seeing anything that suggests that this pop is over. Both the momentum indicators, the RSI or the MACD indicators, remain positive for now. The volume is moving higher, but we're not seeing this big sell-off yet. Now, when we look at the SPX, the cash index, a weekly chart, and by the way, a lot of you say the charts are too dark, you can't see. Now, I'm the Lord of Darkness. I'm a vampire. I don't do good with brightness. But I adjusted the brightness here, so let me know if you can see this better or not. Anyhow, the SPX, the cash index, weekly chart, it is heading exactly the sloping line of resistance. The consensus says we should see a pullback from this point on. But if there is a break above this line and a weekly closing above this line, then we have to recalculate because this is a reversal of a bearish theme. This is a reversal of a downward trend. And we can no longer ignore this if we have a decisive weekly closing above the line. Keep that in mind. Here's the Q's 30-minute chart for the NASDAQ. Again, a pop higher. Then a move down, and the chart consolidated all the way, closing pretty much exactly at the resistance at around 294.33. But in doing so, forming a bear flag pattern, indicating when we look at the RSI and the MACD being elevated altogether, the likelihood is down we go in a retest of at least 290 as support, and then we'll take it from there. But the problem is, if you're betting on a pullback on the Qs, tame your expectations, because the daily chart for the continuous contract suggests that this is not over yet. All what we saw is consolidation within a range today. The MACD remains positive, so is the RSI, and the chart could be consolidating right now, eyeing the resistance at around 12,207. Absent of a big flush down that takes out half of the body of the breakout candle that you see in green here, you don't have a reversal yet. When we look at the IWM 30-minute chart, what's going on here? Again, a pop higher. Couldn't make it above 188. Couldn't stay above 188. And the chart is consolidating in a bear flag pattern. And if this plays out, we could go down all the way to 183. But mind you, the daily charts remain positive. The SPY, in the Qs, in the IWM. So don't be too bearish here, betting on a reversal right now. Be cautious, even if you are on the long side, because this is not convincing yet. You got Powell coming out with the 50 basis points in December, and yet the market is not buying it. Something is wrong here. Something is fishy. So be as conservative as you can, both in the long and the short side. Here's the dollar. The double bottom is gone now. This is the daily chart. The RSI goes back to negative. So is the MACD, indicating that perhaps the dollar is not ready right now to catch a rebound rally, a correction, an oversold rally, whatever it is. It means it wants to go down to another support before finding the energy to do this rebound rally and fix the oversold conditions on the RSI and the MACD. The next support I see is 103. If that is the case, there's another pullback coming, a big one in the dollar, and therefore I say look at companies that benefit when the dollar goes down. And the confirmation of all of this is the chart of gold. We're looking at a daily chart right now, and in the beginning of the week, we floated two ABC theories. A reverse ABC that could take gold all the way down to 1,685, or a bullish ABC pattern that could take gold all the way to 1,842. I was leaning into the bearish ABC, betting on a rebound for the dollar, and gold goes down back into support of 1,685. But we're seeing the opposite happening here. Gold moving higher, dollar goes down, so we have to adapt. Furthermore, when we clean up the chart, still a daily chart, we're just zooming out a little bit, is what we're seeing in gold a reverse head and shoulder formation. And if it is, then this is a bottoming formation, which means the dollar has already topped and down it goes from this point on. So we have to look at themes that outperform when the dollar goes down. And if you want to play the long side for gold, you can buy gold miners, GDX. That's my way to go. And here's the weekly chart for UK oil, Brent oil. What do we see here? Still battling 85 between support and resistance, but it appears for now that oil is finding some footing here, and therefore I've been cautious against betting against oil right now. You gotta see a decisive break of 85 as support before we say, okay, we gotta go short oil right now. Absent of that, this remains a battlefield, and if oil bulls start to win, we will see a short covering rally, a big one, which could send Brent oil all the way back to the hundreds. So watch out here. Now, here's a daily chart for the 10-year yield. The flush down after Jerome Powell continues, and now we're all the way back to the target of 3.5. So can the 10-year find some footing here? My bet is it should. But if it doesn't, we could see a massive flush down in the 10-year yield. And of course, the bulls would look at that as exciting. Peak interest rate hikes, right? But if that happens, the 10-year is going down for the wrong reasons, indicating a recession. Again, be careful what your assumptions are, because here's the TLT, a daily chart. It went down in a retest to the upper range of the resistance zone. It caught support, and it blasted significantly higher, above the resistance of the gap. The TLT is moving higher, and the next resistance I see is 109.5. And of course, once again, the bulls would look at this, we're talking about equity bulls, would look at this as an indicator that we should go long and risk on in the equities market. But be careful here, because if folks are buying bonds, if they're exiting SPY in the Qs by the tune of $11 billion and they're buying the TLT instead, this is not a good sign. This is a sign that investors are hedging big time. They're going to the ultra safety of bonds because they're anticipating a recession. The VIX 4 hours chart, again, it continues to flush down. We're now at 20. This is a critical point. The VIX caught support from 20 over and over and over again. And to me personally, if you believe that equities will go down again in 2023, now that the VIX is really cheap at 20, buying puts, whether you're betting against the market or you're hedging, is a good idea. Go back to the same time of the year, last year, when the market was amidst the so-called Santa rally and the VIX went down to 20. And that was a good buying opportunity. And I told you back then, a good buying opportunity for puts. They're really cheap. Buy them for next year. And next thing you know, the bear market starts in 2022. And flipping those puts produced massive gains because we bought them at a cheap price and we closed them at massive gains. 400, 500, sometimes over 1,000% gain. So this is how I'm thinking right now. I'm shopping for puts, be it hedges on my longs or even betting against individual stocks. Apple, 30 minutes chart. What's going on here? It continues to consolidate. A little better than the Qs because it is not consolidating in a bear flag pattern, but it reached yesterday's highs and it couldn't make it. It closed, if you see that last candle, it closed at the lows of that candle. The question now becomes, is this a formation of a double top? If it is, down we go all the way back to 145 as support. Tesla, 30 minutes chart, again, looking a lot better than the Qs or the SPY. We see the pop higher. Couldn't make it above 194.75, but now the chart is consolidating in or around this number. Of course, we have a catalyst in this chart with Elon Musk revealing the semi-truck. If that is a hit, higher we go. If that's not a hit, we will see a flush down and the next support once again becomes 180. What about tulips? Bitcoin, 4 hours chart. Again, we have a bear flag followed by a bull flag, and the bull flag is playing out for now. So we have to identify resistance, and for that, we clean up the chart. Still 4 hours chart, but we're looking now at 17,500. I like to be a little more conservative and go with 18,000. So I'm not going to be convinced that Bitcoin is worthy of trading higher right now until I see 18,000 as support. Otherwise, we're going down to 15,000. And if you think I'm crazy, listen to Mark Mobius, who says that Bitcoin will go down to 10,000 in 2023. So if you think 15,000 is crazy, the guy says 10,000. And then we have other people, other experts who say that Bitcoin will go down to sub 5,000 in 2023. I'd like to keep it real here and one step at a time. I'm looking at the chart and the next support I see, the legitimate support, is around 15,000. If that's broken, then we'll talk about the ultra bearish scenarios. But for now, let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? How about the most important non-farm payrolls? It comes with the unemployment rate, and most importantly, the average hourly rate. If we see creating more jobs in the economy, but wage inflation cools down, that would be good news for the bulls. But if wage inflation continues to go up, I don't think this is going to be good news because the Fed will look at it as, we got to be careful here. Maybe the slowdown from 75 to 50 is merited, but we got to be careful about the messaging because if the market and the economy senses that we're getting too loose, too fast, we will see inflation expectations moving higher again, and along with that comes wage inflation. Anyhow, folks, this is all I got for you for now. Once again, thank you for listening, thank you for watching, and I will talk to you again over the weekend. Stay tuned.
You want to know what it is? What it's all about? John, chapter 9, verse 25.
I haven't been to Sunday school in a long time.
Whereas once I was blind, now I can see.